Let's talk about 7 mistakes that are delaying your dream retirement. Now, some of these are fairly obvious, and some of these may not be quite so readily apparent to you. So, hopefully, if you go through these 7 mistakes, you'll get some value out of it and some ideas for how you can make sure your dream retirement is going to be delivered to you on time. Now, the first one is just not starting early enough. A lot of people have kind of seen these kind of charts before about the power of compounding and how important it is to have a long runway. In fact, I like this chart here from Fidelity. It just shows you what happens to somebody who starts saving $6,000 a year at 25 versus somebody who's starting at 30. Basically at a retirement age, they're going to put this at 67. The difference comes out to be almost $500,000. So even though the difference in contributions is only like $30,000, the difference in final value is just massive. And again, this is just the power of compounding at work. Earlier you can get started, the better. And I think that's true about a lot of things in retirement planning. The earlier you can start planning, the more you can optimize, the more levers you can pull to set yourself up in that perfect position for your future dream retirement. Now, a second big mistake that can delay your retirement is understating the cost of retirement. Statistically, costs do go down when you hit retirement age, but depending on your lifestyle, you can see costs go up. And, all of a sudden you're going to have a lot more free time where you used to be working. Activities like traveling and golfing and shopping and eating out, it all takes money. It's also why people often look at different kind of phases in retirement. There's the idea of those go-go years where you may spend more, but you want to make sure you're taking in all the cost. Healthcare, obviously, another huge one. If you're going to retire before full retirement age and you're going to have to pay out of pocket for healthcare, you got to have a good handle on that. Go run some estimate. Go get quotes from the government health website, get an idea of what marketplace insurance will actually cost you. Another thing I often see is a lot of people just underestimate their spending. When I ask clients or prospects to put together a budget, give me an idea how much you're currently spending, I often kind of find out that it's 20, 30% under their true expenses. So if you can really get a handle on your true spending today, you'll have a much better picture of where you're going to be at for retirement. So you can figure out how much you truly need for that ideal retirement. Now, the third big one I see, huge mistake in my opinion, is typically taking early withdrawals from retirement accounts. So, one, you've got penalties and taxes on these withdrawals. And so that's, a big setback to your savings right there. You're losing the compounding on that. And often, and why I think it's often such a mistake is because you're funding a lifestyle that's kind of beyond your true means. It's beyond your cash flow. And, I just typically find the people who have to tap that or feel like they're justified in tapping that retirement account early, often they're just underestimating spending. They just don't truly have the cash flow or retirement assets to kind of be on time for retirement, especially relative to their goals. Those are people often with more aggressive assumptions. There are things out there that can kind of help you if you do want that money early. There's the rule of 55. So if you leave a job at 55 or later, you can tap that 401k without paying penalty. But again, you're losing years of compounding. You are paying taxes on that money unless it's in a Roth 401k. At 59 and a half, you can tap retirement accounts again without penalty. However, once again, you're giving up compounding, and you'd probably only want to do that if that's part of your early retirement strategy. Another one I see is just having an insufficient emergency fund. And this kind of piggybacks on the third point. When people have to kind of tap their assets and prevent the compounding, that can be a real problem that sets back retirement. Those who already have the emergency fund ready to go, they can pay for things like replacing a roof, the HVAC, the unexpected car repairs, all that kind of stuff. So, having that emergency fund so that you can keep the rest of your assets invested and growing can often be very helpful. And just, having the financial wherewithal to sort of weather those hits. People have to buy new cars every few years, you gotta do repave a driveway sometimes, replace a roof. These major expenses that seem like one-offs end up recurring every few years. So you just want to be sure that you are ready for some of those and that it won't offset your retirement plans. Another big one gets back to the kind of idea of compounding, and this is not overpaying fees and taxes. So, on taxes, you want to make sure you are maximizing your tax advantaged accounts and maximizing your tax situation. I can't tell you how many times I've seen the situation where clients will be kind of at their peak earning years, they're planning for retirement, we're only a few years away, anywhere from 0 to 10 years, and it's pretty evident that the tax rate that they are paying today is much likely to be higher than the one they are in the future. And yet they are saving into, often saving quite a bit of dollars into taxable accounts. And they still have capacity to save much more into 401ks, HSAs, tax advantaged accounts, which is going to be a nice tax savings. If you're at a high tax bracket today, one of the high tax brackets, and you're paying 32, 35% taxes today, you might be in a much lower tax bracket at retirement, especially before RMDs, or if you retire before you take Social Security. So, and there's a real opportunity here, making sure you're optimizing that. Fees, kind of the same thing. I like this chart here. It just gives you an idea of the impact of fees on compounding. If you're paying, a lot of low cost ETFs now have fees as low as 5 basis points, 0.05%. Alternatively, kind of some traditional mutual funds can charge, up to 1%. And I've seen much higher than 1%. And over the course of 10, 20 years, that really does add up here. I mean, in this example, $100,000, what it grows to in 20 years, the difference between the lowest fee and that 1% fee is over $100,000. So very significant. Be wary of paying excess fees. Be wary of not optimizing your tax situation. Another thing to think about kind of with those fees is the sixth point. It's just poor investment choices in general. So, it's not uncommon to see people trying to time the market. So when we've kind of been on a run, stocks are doing well, you'll see a lot of people get overly aggressive relative to their true risk tolerance, relative to their goals. And then, when there's a downturn, you'll see a lot of people sort of abandon their strategy and go to all cash. I saw so many people go to all cash back in 2008. It was just so common to see 08, 09 people abandoning, going to all cash, and then missing much of the upside in the years that came at a generational low. So you just don't want to, be chasing the market. You want to make sure your asset allocation is appropriate, your matches your risk tolerance, matches your goals to the extent you are trying to optimize for market environments that you are either putting the time and research in or working with the kind of a professional who really has some insight into, how you might want to best allocate for your risk tolerance and the current investing climate. So I think just kind of like with fees can make a difference, poor investment choices can make a huge difference. And there's a lot of kind of research and quotes out there that kind of show just how badly average investors have lagged markets and have lagged mutual funds and ETFs because of their poor timing of their flows. Again, rushing in when things had been good but are set to do poorly in the future, and abandoning when things are poor but are set up to do well in the future. Human nature, unfortunately, does not work well for us in investing. The other thing too I see with poor investing choices, you get a lot of people who kind of just start almost trading on the side, gambling. There's this idea that in an up market, everybody is a genius. I've heard Warren Buffett kind of say before, you don't know who's swimming naked until the tide goes out. We've kind of had a pretty big bull run without too many major corrections, really since 08, 09. And so a lot of people think they're fantastic. And the more risk you've taken, kind of the better you've done. But you want to make sure that you're, again, not sort of gambling on this, but you're doing this in a well thought out way. We want to get you to that comfortable, secure retirement. We don't want to take unnecessary risk. And, as just a side note with this, I've seen clients before or prospects come in the door and for their ideal retirement, only being a few years away, they really just needed very conservative returns. I'm talking 3%, 5% returns would get them the kind of nest egg that should be able to last them for a really fantastic retirement. Another way to think of that is they probably just need conservative investing returns over the rest of their lifetime, and they will have a fantastic retirement and they'll be able to do all the things they want to do. And yet they were extremely heavy on stocks, extremely heavy on crypto. The stock portfolio was in some of the riskiest stocks. And, just like trying to hit home runs. And the portfolio just needed base hits. You're not saying that you can't take risk and you want to do things to optimize your returns, but you don't want to expose yourself to downside where it really would alter the retirement, really would alter your goals. So just want to make sure that portfolio is aligned. Now, the last mistake, this one's really easy, really sneaky, is lifestyle creep. As your income rises, so do your expenses. You are typically hanging out with people that make more. It's so easy to get settled into a certain level of spending. That's one of the reasons I always want to check in with clients on where their spending is at, because it's really, really, really hard to dial it back. You get used to a certain car, you get used to doing certain things, eating out a certain amount of times, hanging out at a certain country club or a certain whatever. It's really hard without drastic life changes to pull that back in any significant way. You can get out in front of it and avoid that lifestyle creep in the future. That could be really, really helpful. And, the solution to kind of all these problems is planning, right? If you are getting an idea of your spending, if you're planning for the future, you're making sure your asset allocation is appropriate for your goals, you're going to be in such a great spot to just kind of optimize your life, your planning, your assets so that you can hopefully have that retirement that you dream of and that you're able to take real advantage. So, appreciate you tuning in today. My name is Scott Caufield. I am a CPA, CFA charter holder, and the founder of Sophos Wealth Management. Always appreciate if you like these videos, subscribe to my channel, and check out others if you want any more information. Thanks.